You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, that music means we are back. It is Education Wednesday. Time once again to dive deep into the misty, murky waters of options education and have a little fun while we're at it. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the Options Insider Radio Network, available wherever you get your favorite podcast. Not just this show. We love this show, but of course, a whole network, over a dozen shows coming at you, and has been doing so now for 19 years. This January, 19 years. Wild. Crazy to say all that madness out loud. Of course, next year, the big 2-0. And what we're going to do, I have to have a big fun party. In the meantime, if you want to check out a fun vol party, very germane to our subject for the show today, including maybe a little bit of an old vol deathmatch. You want to see the Flow Master pitted against Scott Nations in a volatility battle to the death. That's coming up pretty soon. Check it out over there on the Pro. Theoptionsinsider.com/pro is the place to go to learn all about that. As we learn who's joining us on the old OBC program today, I am pleased to welcome back my good pal, Mr. Daniel Prince Adam Passarelli III, Esquire. Mr. P, welcome back to the show, sir.
Hey, it is great to be back. I'm back in town. I was out of town last week. Holy cow. I've been gone for 10 days.
Did you have a fun trip? Do anything cool? Day drinking all day?
No day drinking. Did some fishing. Caught some really big fish. That was pretty fun.
I would ask you how big they were, but I know you're a trader and you would lie to my face. So therefore, the trading and the tall fishing tails combined would make for quite the whopper of a story. But I called you Prince Adam, sir, because I have that tune in my head. I'm not sure if you saw it, but they released a teaser trailer this morning for the new Masters of the Universe movie. Yeah, if you're a kid of the 80s. I had heard about that coming. I kind of dismissed it in the back of my brain. So it's probably going to be garbage. And who knows? It might be hot garbage, sir. But the teaser trailer just strikes right to the core of the 80s nostalgia bone. Those teaser makers, they know what they're doing. Those trailer men, they play that little theme song in the background. They show 80s imagery and cereal and all the great stuff. And Dan, I have to say now, it worked on me. I am unreasonably excited, sir.
Oh my gosh, that's so funny. Like, I would not even imagine that was going to be.
Exactly. That's why it's so awesome. It kind of hits out of left field. But the second you hear that theme song, if you're a kid of the 80s, you're like, whoa, your ears perk up. And you get a little excited. Your blood starts pumping a little. They know what they're doing. Those bastards over there in the trailer production mafia, they know how to get right at you, Mr. Dan. So I am fired up for the show now after hearing that. What do you say, Dan? We collectively become masters of the Volatility Universe. How does that sound?
That sounds like a lot of fun.
All right, to a little bit of basic training. Let's go.
All right, Boot, it's
time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
All right, Dan, welcome to the basic training, the portion of the show where we break down some basic options concepts or techniques or strategies, and we go into them a little bit more detail so you, the new options trader, can come to grips with them in your own trading portfolio. And before they come to grips, Dan, with a little bit of Vol, our chat pointing out a useful point, which goes back to our day drinking theme from earlier, which is the show and the network is 19 years old now, so they can legally drink in Canada, Dan.
All right.
Not quite in the U.S. Got a few more years to go here in the U.S. before we can legally drink here. But if you want to go up to, I don't know, Montreal and have a brew, then our network can do so, Dan. So I guess congrats to us. Maybe you have a little poutine on the side, whatever those folks do while they're slinging the loonies up there in the Great White North. Let's sling a little Vol, Dan, shall we? Listeners, I did a little digging before the show just to see, when's the last time we chatted about straight Vol? And it's been a while, which means it's time for a bit of a refresher. If you want to go back into the archives and check out some episodes that kind of dovetail with Vol a bit, if you go back to the end of 2024, November 20th of 2024, to episode 315, we talked about navigating Vol products. In fact, the last few times we talked about Vol on the show, it has been through that lens of the Vol ETPs, your SVIXs, your VXXs, all those different products of the world, and how they work, or more reliably really don't work, and how you can take advantage of that. We talked about them in September of that year as well. We talked about ETF Vol mysteries. So again, going back to the ETF side of the equation for episode 306, episode 293. So 2024 was kind of a big Vol products year on the network. We talked about earnings Vol in particular on that episode. So again, kind of slicing up the Vol pie in different ways. Episode 273 from January of that year, we talked about inverse Vol. This wasn't that long after the return of SVIX, the inverse Vol ETP. So listeners had some questions about that. We tackled them there. And then go all the way back to episode 222 from February 1st of 2023. So coming up on 3 years now. We talked about kind of our first foray into exploring the universe of Vol products. If you want to dip your toes into the universe of Vol products, there's a bunch of episodes you could check out, especially if you're newer, or if you haven't delved into the archives in a little bit. But let's talk about Vol, Dan. When I say the term Vol, let's play a little word association. What springs to mind, sir?
For me, I immediately start thinking of implied volatility and structuring option positions based on it.
We kind of do a lot of that here on the show. So even if you don't know about it, listeners, we have been talking about Vol for quite some time here on this show. And you've been trading options. You've been trading Vol, even if you're not aware of it. People get confused sometimes between, the directional movement of a stock and Vol itself. And Dan, I heard this good analogy the other day. I thought it was useful for the show. A good analogy for Vol is, instead of thinking about as, the direction you're driving a car, instead of thinking, hey, I'm pointing north, south, east, or west, so the stock move, in this case, moving up or down, that doesn't really matter. It's more the speed, aka the velocity of how fast you're getting there. So think of the Vol as more of the speedometer of your car rather than the direction you're heading. What do you think about that, Dan?
Yeah, you know what? I do like that analogy. It's just, a lot of people really do struggle with it.
So that's basic Vol itself. It is the speedometer of your car. It is the magnitude of the price swings that you're seeing and whatever underlying you're looking at. Pick your poison. Gold, S&P, crypto, whatever you're trading options on. The magnitude of the moves in the underlying. That is what is Vol at the end of the day. Now, Vol does come in various flavors. You can look ahead, you can look behind, you can carve it up in all sorts of different ways. Let's start looking back, because that's what a lot of people use when they're analyzing Vol. A couple different terms for this. A lot of people refer to it as historical Vol. Other people call it realized Vol. Dan, which way do you fall on that? Are you a realized Vol guy or a historical Vol guy?
I say realized Vol more often. I use them pretty interchangeably, but when I'm talking about what the historical volatility might be in the future. It just gets weird saying future historical vol. So that's where I use realize just to make it less oxymoronic, I guess we'd say.
Yeah, I've always been a realized vol guy as well. I'm not sure where that came from, how I lined up that way, but I don't really say historical. Maybe for the reason you broke down, it gets confusing when you start talking about historical vol in a variety of contexts. But yeah, I've always been a realized vol as well. What are we talking about, listeners? Historical or realized, whatever you want to call it, at the end of the day, is really just measurement of how much that particular underlying, could be a stock, ETF, future, whatever you're looking at, how much it has actually moved, how much has actually fluctuated up and down over whatever period you're looking at. Could be 30-day, could be 60-day, 90, 180, whatever period of historical or realized vol floats your boat. And it's an actual concrete number. There's no guesstimate here or anything like that. This stock has moved and fluctuated this much over this time period, and that equates to this number for historical or realized volatility. So it's a very concrete thing. It's something that is knowable, which is why at the end of the day, a lot of models rely on this. A lot of prognostication tools rely on this, because it's something that at the end of the day is something you can calculate. And at the end of the day, it's very simple and straightforward to calculate this, as opposed to the implied, which we're getting to in a little bit. Dan, anything you want to add on realized or historical vol?
No, just that, it is good to know that it is that concrete number, like you pointed out, where you can calculate it and you can see a historical volatility chart, even if there's not options traded on it, which can kind of be useful to any trader or investor, even if you're not into options.
Who isn't into options, Dan? What kind of a savage would they be? A, and B, why are they listening to this show? They're listening to the wrong show. So we're talking solely to the options crowd. Everyone else, they can go fly a kite, Dan, as the kids like to say these. I heard that's a hot thing with the kids again. Go fly a kite. All right, let's keep rolling. Let's go out to the other side of the coin. We did realized or historical first because it's a little easier to wrap your head around, because as I said, it's an actual number. Tesla moved X percent, had exhibited X percent volatility over this 30-day period. It's a concrete number. There's no arguing it at the end of the day. Now, when we get to the other side of the coin, trying to forecast vol a little bit, that's where things get a little bit wilder, a little bit weirder, a lot more fudge factor baked in to this. In fact, at the end of the day, Dan, I often say that implied vol is kind of the fudge factor of the options market. You go back to the early days of options, early days of Black-Scholes, which, by the way, I will be talking about with John Smolin from MIAX and Greg Stevens from Fidelity and Tony Saliba on a panel tomorrow talking about the origins and the last 50 plus years of the options market. So if you want to dive into a little options history with us, stay tuned. I think some of our pro members may have a chance to hear that. I'm not sure if we'll be able to put it out to the full network or not, but should be a fun time, which is why our pro folks are getting so much content in their ear holes today. I'm going to be busy tomorrow down at the conference. But that said, Dan, I've always referred to implied vol as the fudge factor, because if you go back and look at Black-Scholes, they have this nice equation that's all carved out. They win a Nobel for it, so it's a pretty useful equation. It kind of birthed an entire industry at the end of the day, options trading. But at the end of the day, they're kind of like, and then there's all this other stuff. And it all just kind of gets lumped into implied vol. So that's why I kind of call implied vol the fudge factor for the options market, because you can make any price make sense, Dan. All you have to do is raise or lower your implied vol estimate, and lo and behold, oh, wow, that price makes total sense now, Dan. So what do you think of implied vol as the fudge factor of the options market?
Oh, man. I'll tell you, I have a lot to say about implied volatility. I look at it, I think, a little differently than most people do. And I don't know, I really kind of poo-poo the whole thing of implied vol being the market's estimation of future volatility. I think that that's a bunch of baloney, which is, a little bit counter to what a lot of people in the options market say, but I could talk about that for hours. So
Well, let me set the table for the folks with some basic definitions, Dan, and then you can hold court for several hours. How does that sound? I'm not sure if we have that much time on the network today for you, but I can give you probably 20 odd minutes. How's that sound?
Yeah. Well.
All right. What are we talking about here? What is getting Dan all hot and bothered? What's making him put down the bottle of Malort for the day drinking today just to talk? We're talking about implied vol. And again, it is kind of that fudge factor. It is that forecast at the end of the day. When you look at the implied vol, you look at the Black-Scholes model, it's effectively telling you what the options market is attempting. And, it's really at the end of the day, it's like predicting the weather. How accurate is it, right? But it's what the market is attempting to predict what the future vol of that product is going to be. And again, it varies by time period. The standard metric, the standard time frame that most folks look at when they're talking about implied vol is 30 days. In fact, VIX is, the 800-pound gorilla in the vol space. It is the brand that is synonymous with volatility, aka the fair gauge. What is that? It's effectively a rolling 30-day gauge of S&P 500 at the money vol, with, of course, a little bit of skew and some other little factors thrown in there. So at the end of the day, implied vol is a forward-looking measure of volatility, and that's really how it differs from historical vol. Historical vol, an actual or realized vol, an actual concrete number that can be easily calculated, and it's not really arguable. Looking ahead, though, your best estimate for a vol, well, obviously that's highly subjective. And you have 5 different traders, they might have 5 different vol estimates for a particular underlying. Maybe they're factoring the earnings vol a little bit differently. Maybe they're factoring some other big key event or market milestone that's going on during that time frame differently. And that's why you can have wildly different markets. Sometimes on the floor, they would call out an option market, and you'd hear, one person make a market, maybe they're, 1.5 bid at 2 or something like that. And someone says at 1.5, you're like, whoa, because their estimates for implied vol are wildly different, obviously. Maybe their models are wrong too. There's sometimes you'd have issues. If you heard that, you'd be like, wait a minute, am I wrong? You'd always have to second guess yourself, because trading local to local was usually verboten down there at the end of the day. But sometimes you say, what, I'm right, you're wrong, I will trade with you. So several different traders can have wildly different estimates for what they think implied vol is going to be going forward. And at the end of the day, the differential between your prognostication and my prognostication of implied vol is usually what results in these wildly different options prices you're seeing coming out of different models. Because at the end of the day, your interest rate probably isn't going to differ too much. It might differ a little bit. You might get a more favorable rate than the guy or the firm next to you, that sort of thing. But at the end of the day, a lot of those other factors are pretty stable. It really comes down at the end of the day to the big fudge factor known as implied vol. All right, Dan, I set the table for you. You can now hold court and vent your spleen on all things implied vol, sir. Why does it make you so hot and bothered?
Well, because look, I'm on the front lines here, as are you to some degree, and I mean, I talk with retail traders every single day of my life, often including Saturdays and Sundays, and I know that a lot of newer traders, which makes up the biggest set of traders, right? There's often new entrants into trading, and a lot of them end up quitting after a while, but there's just new entrants. And there's a lot of people who just simply don't even look at implied volatility when they trade options. Obviously, a big mistake, but they don't. And when they don't, they are affecting the volatility market. If they're buying calls because they think, some hot stock is going to continue going up, well, they're making implied volatility more expensive. And sure, if it's just a one lot or whatever, fine. But, people subscribe to newsletter subscriptions and such, and somebody recommends buying some call, and, you get 100 traders all buying 5 lots. I mean, it's going to drive implied volatility higher. People selling covered calls without looking at the volatility drives volatility lower. There's an immense amount of noise in the volatility market. Volatility is always wrong from the degree of predicting future volatility. There are some professional traders who trade bigger positions, who do trade volatility and do look at it that way. And that does add to the price discovery process for volatility. But there's just so much noise in the market that I like to remind people that it's a measure of the supply and the demand for options as opposed to the market's estimate for future volatility.
Again, a lot of different ways to carve up that onion, because you're right. Go back to the 2021 meme stock days, right? That was very much straight supply and demand. Everyone had to have the upside and pick your meme stock of choice, right? So the skew got bid to high heaven. The implied vol in those strikes got bid to high heaven. Doesn't necessarily mean the market makers were necessarily predicting a 300% or some of those strikes 1,000% vol. It's just that was the supply and demand. They had to keep selling the options, and that was the price they were comfortable selling them at that point. So that was the level of vol they were comfortable selling that to. So there is definitely that real world dynamic at play, Mr. Dan, which I'm glad you added here to the show. I'm glad you put down the bottle of Malort a little long enough just for us to chat about a little bit of implied vol. Why are we talking about this? Well, first off, because I haven't talked about it on the show in a while. And B, because it's that time of the year, we've been talking a lot about vol prognostications. I will get Dan's in a few minutes for the end of the year. But also C, because at the end of the day, a lot of you are premium sellers. You like to collect a little bit of income. So at the end of the day, whether you know it or not, you are doing a time-honored tradition in the options market known as harvesting the Volatility Risk Premium. I know it's a long term. What the hell does that mean? Well, effectively what that means is the topic we just talked about, implied vol. That is a forward-looking estimate, aka reflection of the supply and demand for those options. And then, of course, historical or realized is a backward-looking, not an estimate, but an actual concrete number. So when you're going ahead, when you're going forward with vol, obviously no one knows the future. So you have to build in, again, going back to that term, the fudge factor. That is implied vol. You have to build in a little bit of juice, a little bit of flexibility in case things go against your prognostication out there, which is why at the end of the day, 99 times out of 100, you're going to see implied vol trading at a premium to the historical or realized vol. It's just the most lazy way to do a model. At the end of the day, if you want to do a vol model, you look at what vol did this underlying exhibit over the last 30 days. Okay, that's the realized vol. I'll take my 30-day implied will be that plus a little bit of fudge factor. And that's sometimes the lazy way people go about it. But that's kind of the base way to make a vol prediction at the end of the day. What was the actual realized vol? Okay, I'll top on a little bit of extra juice because no one knows at the end of the day. And thus I will come around to my implied vol estimate out. And that's why 9 times out of 10, you're going to see the implied vol trading at a higher level to the vol that it has exhibited in the past out there, listeners. What does that mean? If you're selling options, you obviously want that implied vol to be higher, and you want it not to exhibit a lot of realized vol during the time frame that you are short those options. You want to collect that implied vol premium at the end of the day. You want the actual vol that you sold, the implied level, to be a lot higher than the actual vol that the underlying exhibits. Nothing's better than coming into a high-flying tech name, YOLO name, whatever it is, selling far out of the money calls or maybe more at the money stuff at crazy implied vol levels, 100, 300, 1,000%. And then the stock sits there and does nothing until expiration. That's the ideal dream scenario. Then you have harvested the maximum implied vol premium or volatility risk premium at the end of the day. Typically, you're not going to get all of it. You're going to get some portion of it. And that's why a lot of professional traders, since time immemorial in the options market, have leaned to the dark side because they say at the end of the day, I know if I'm buying implied, I'm buying an overpriced vol 9 times out of 10. Why should I do that? I should sell it. Of course, there are reasons to buy vol. We've discussed that many times here on the network. But if you went back to the early days, the 80s on the trading floor, even into the early and mid 90s, even when I got down there in the late 90s, there were still a lot of older trading groups that all they did was sell vol, Dan. That was their thing. They said options are overpriced. They are insurance. You don't make money buying insurance. You make money selling insurance. And that was the mindset until we saw kind of the big market moves of the late 90s, the dot-com boom. And all of a sudden, a lot of those firms blew out because they were short boatloads, boatloads of premium, boatloads of gamma. And they started saying, well, maybe not every strike. And that's where we started to get a little bit more evolution on the risk management, sir. Dan, what are your thoughts on that implied vol premium and the notion that at the end of the day, a lot of firms, even till this day, all they do is want to harvest it?
Yeah, I mean, I think sometimes people lose sight of why they're harvesting it and why it makes sense to. It makes sense to because of the existence of the risk premium, because it's statistically overall, generally, most of the time, overpriced. But it's not always. If you lose sight of that and you just sell volatility with complete disregard to whether it's overpriced or underpriced, and don't care about that and don't think about that, then you're going to lose. That's a non-winning game, and I think that's a lot of what happened back in the day. Is even some of these big firms lost sight of that, and they're selling underpriced volatility. Actually puts you at a disadvantage.
And that raises the question, of course, how do you tell if it's overpriced or underpriced? There are many different ways. We talked about volatility cones on this network in the past. It's a great tool if you want to see where the vol level that you're currently selling, how it stacks up on a historical basis on your underlying of choice. If you're trading some high-flying tech stock and it has traded historically at a 130 vol because it's moving all over the place, and you're coming in, you're selling, let's say, a 60 or 70 vol, you might say, well, maybe I'm selling a little bit too low here on the vol. I'm not really getting rewarded for the risk that I'm taking. On the flip side, if you're coming in to buy those and you're buying a level that is far above the historical or realized norm, then maybe you might want to say, maybe I'm overpaying for this vol. That's something that happens a lot heading into earnings. People overpay dramatically for earnings vol. What happens, we talked about it many times on this network and on this show, you get that vol crush after the earnings announcements, like that balloon pops. And even if you get a nice underlying move, the vol crush is usually more than the underlying move, and it's going to overwhelm the delta at the end of the day, and you're still going to lose money on that trade. So again, why you need to be cognizant of the vol level that you're trading. In general, if you're coming in and that implied vol that you're selling is dramatically higher than the historical or realized vol that you've exhibited in that underlying, first off, maybe do a little bit of analysis. There might be a reason you're unaware of. Maybe there's surprise earnings, the CEO stepped down, something funky happened in that underlying to make it such a differential between the current implied level and the historical. But if you do your research and you don't find that obvious catalyst, maybe A, keep digging, and then B, maybe it's a good time to nibble on a little bit of short options. The flip side of that, not a scenario you see very often, Dan, but one that does happen every now and then, where implied vol is below realized. And that's a strange scenario. Again, doesn't really pop up too often. That means this underlying has exhibited a ton of vol in the recent past, and then all of a sudden, for whatever reason, market makers are coming in and they're pricing less. It could be, as Dan was saying earlier, supply and demand. The whole market is selling options to them, in which case, guess what? They're going to have to lower their implied vol estimates just to have a functional supply and demand economy at the end of the day for options. But that said, that is a strange scenario, and you, as the end options trader, can benefit from that. Maybe you get a cheap bite at the apple, much cheaper than it would usually be and probably should be, given the amount of movement that has been exhibited in the past. So, Dan, what are your thoughts on those scenarios where implied vol is dramatically above or dramatically below the realized vol, sir?
Oh man, I love those scenarios. Love it. I live for those scenarios. That implied volatility, when it's out of whack and it gets out of whack, can be your greatest source of edge. It just creates opportunities.
There you go, listener. So a little vol refresher for a lot of the newer listeners of the show. Listen to this episode. Maybe go check out some of the archives where we talk about the specific products and some strategies. And then you too, Dan, can be a master of the Volatility Universe, dare I say it. And before we get out of here, I want to get Dan's prognostication. That means it's time for a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, Dan, you and I were off last week, no live show, so we didn't get a chance to get your prognostication live then. We're going to do it now because this is the time of year, listeners, where we ask our audience for their official VIX prognostication, their end of the year VIX cash. Again, not talking the futures or anything like that, just talking where VIX cash is going to close at the end of the year. Dan, our audience weighed in. We gave them 4 zones to weigh in. Now we said under 15, so relatively quiet end to the year. Pretty close to that this year. In fact, we were in that zone ever so slightly. We closed at 14.95, I believe. 15 to about 18, 18 to 21, and over 21, so a spicy end to the year. And Dan, 15 to 18 took it with 42.3% of the vote. About almost 31% came in for over 21, and then about 19% for under 15. So you add those two together, you actually get pretty much exactly 50% for one of the wings, either going to be really quiet or kind of spicy at the end of the year. Half of our audience is feeling that. Only 7.7% going for a little bit elevated 18 to 21. They also wrote in with a bunch of their own specific prognostications. We've also been getting a lot of our guests here and co-hosts on the network to weigh in with their end of year prognostications. Now, Mr. Dan, it is your turn. I will say your nemesis, Mr. Uncle Mike, has already played. He has already weighed in with his end-of-year vol prognostication. So can you one-up him, sir? What is your end-of-year VIX prognostication, sir?
Well, I think we're going to see a lot of volatility this year, but since we're looking at a specific spot in time, 12/31/2026, usually that week tends to have lower volatility. And, you know, we're closed the next day, and so that makes the VIX look a little bit lower because you got that one extra day of theta in there. So probably I'm with the majority on this one, 15 to 18, because I think it'll be high, but I think on that particular day, you know, it'll be less high than the average of the year.
And what is your specific number, sir? We need it for the records.
Oh, a specific number.
Yes. Let's see if you can outdo Uncle Mike and all the rest.
I'm going to say 1523.
1523 is where Mr. Dan is lining up. By the way, your nemesis in life, Uncle Mike, he was at a 1378, so he's feeling a lot of vol annihilation at the end of the year. We had a lot of prognostications and write-ins out there. There were some issues. Looks like Twitter was having some issues with polls last week. So some folks, I don't think, were able to get their prognostication in. So if that's the case, maybe we'll open it up to a late round of some last minute. You're only getting it a week or so after everyone else. So it's not like you have a huge edge in your prognostication. We're not doing it at the end of the year or anything, but maybe we'll open that up so a few more of you who had some issues with Twitter last week, maybe you too can play. We want to make sure no one's excluded at the end of the day. Then you too can join on the network side. It was Steve Sosnick, and then this year it was Dan the Man Gramza, the other Dan, and Rich Excel, who got entered into the Vol Hall of Fame that came within 1/10 of a point of the end of the year VIX closing level, which is no mean feat 1 year out. And we had 2 listeners win this year as well. So they won a year of the pro. So you're talking $1,200 worth of prizes going out to them. So congrats to those listeners. I don't have their names off the top of my head, but congrats to all of you. If you haven't played yet, listeners, hit us up. Let us know. Maybe we'll see if we can make an accommodation for you. All right, Dan, that means we come to the end of a little bit of a sojourn through the Volatility Universe. Our chat's also reminding us they came out with a Street Fighter movie trailer as well. So I guess it's a glory time for 80s and early 90s IPs, Dan, to come into the movie theaters.
Yeah, I guess so, huh? Wow, that's interesting.
I'll say Street Fighter doesn't excite me as much, and it doesn't have that iconic theme music that kind of gets the blood pumping a little bit. But hey, some folks, to each their own out there, Mr. Dan. And Dan, while you're eagerly awaiting for the big full trailer drop tomorrow, If folks want to reach out to you, discuss their own 80s nostalgia, or I don't know, maybe talk some vol, where should they go? What should they do?
Of course, make your way on over to markettaker.com, 2 T's in a row.
Markettaker.com. Don't forget the second T for Theta. Check them out over there. And while you're checking things out online, make sure you're checking out our friends over there at Tasty Trade, tastytrade.com/podcast, the place to go to kick the tires and light the fires there, along with all other sponsors on the network, are the reason these shows keep coming at you and have been coming to you now for 19 years, which is absolutely wild. And you know what, listeners, if you're not hanging out in the pro, you're missing out on a bonanza today, because coming up right after this show, we're going to go delving deep into the world of futures immediately after this on the futures rundown. So no rest for the wicked, no waiting out there. Then after that, because we like you folks, we're coming back with a little bit of This Week in Futures Options, because as I said, I will be down at the conference tomorrow. Going to make it hard to record, at least live and stream live from the event. So we'll see what we can do. Flowmaster is in town, so I do want to meet up with him to do a little bit of option block talking on the show tomorrow. But you're going to get Thor, and you're going to get Twifo, and you're going to get the futures rundown in your ear holes right now. So stay tuned. Yet another reason to check out the pro if you haven't already. And then we'll see you back here next week, if I still have a voice after my panel, another episode of Options Bootcamp. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.